if we go into true deflation and AI renders everyone unemployed and is like the biggest productivity shock we've seen in modern history, then we're entering a debt spiral, a level of austerity that like is magnitudes greater than the Great Depression. If retail can't afford their payments, they're rendered delinquent. And what happens? Bank stocks are going to crater. Bank stocks are going to crater because the market will realize they have all these outstanding loans and they're not going to get paid back. When bank stock craters, stock markets crater. Stock markets crater. The 401ks are in the shitter. 401ks are in the shitter. The U.S. government tax receipts are in the shitter. The tax receipts are in the shitter. Then the bond market gets volatile. The bond market gets volatile. The U.S. defaults.
Wednesday delivered exactly what fragile markets often produce after periods of stress: a violent relief rally. After a 48-hour sell-off driven by renewed trade policy uncertainty, risk assets reversed sharply. Bitcoin, which had briefly lost the $63,000 level, staged an aggressive recovery, surging back toward the $69,000 zone within hours. The move was sudden and forceful, fueled by positioning, liquidations, and a sudden shift in market psychology. The backdrop was classic macro instability. Initial optimism following the Supreme Court's tariff ruling gave way to fears of escalation as political rhetoric intensified. That anxiety triggered de-risking across markets, with traders bracing for further shocks. Instead, the anticipated catalyst failed to materialize. The absence of new policy threats during the State of the Union created the conditions for reversal. Short positioning, already crowded, unwound rapidly. More than $248 million in shorts were liquidated in just a few hours, amplifying Bitcoin's recovery and lifting the broader digital asset market alongside it. But while price action captured attention, the underlying story remains structural. Beneath the volatility sits a financial system facing pressures it cannot resolve through conventional means. This speaks to one of Jack Mallers' most powerful Bitcoin predictions so far. According to the Strike co-founder and CEO, policymakers are approaching the limits of denial. The available choices narrow. Default is politically and economically intolerable. Austerity is socially destabilizing. Which leaves the most historically consistent response: liquidity expansion. Mallers' argument is blunt. The system is designed to absorb stress through money creation, and the scale required this time may exceed anything seen in modern history. In this video, we break down why Mallers believes a new wave of monetary expansion is not just likely, but mathematically unavoidable, and why that matters enormously for Bitcoin. If you value structured, investor-focused analysis, hit the like button, subscribe to the channel, and tell me in the comments, is this rally just volatility, or are markets quietly adjusting to a much bigger liquidity regime ahead?
Deflation meets debt. Why a successful AI is bad for markets. So here's the logic, and I just want to break it down for those who don't totally understand. AI is a productivity shock. That's what all technology is, right? Like the car made us highly productive relative to horses. The airplane made us even more productive. Technology are traditionally productive tools. They provide efficiencies in the marketplace that previously were not there. And by the way, that's how the free market and technology works. You don't build something that isn't better than what already exists, because if you do, you'll fail. So this form of Darwinism is the only things that you're incentivized to build, and the only things that succeed are things that provide more value than the things that exist today. And so we have this very efficient system where all technology trends towards being productive because you're highly incentivized to build something that will actually work, that's actually more valuable than what people have today. And by the way, it has to be a lot more valuable than what people have today because the switching cost within itself is decently expensive. So you don't see technology that's marginally better. You see technology that gets way better, and that humans just kick butt at this. I don't see lions building software and shit. We're the best at building tools. So AI is the latest productivity shock coming from us humans, the godfather of all tool building. Okay. What that causes is this term I've been using called deflation. Now, I put in this slide what it's doing is it makes the dollar more valuable. But I don't know if that's going to land with you guys because I shit on the dollar so much, and I can already see my comments. I thought you said the dollar wasn't good. I thought you said the dollar was. It's like, God, you guys just donkeys in my comments all day. So what I mean by it makes the dollar more valuable is what I said earlier. If the marginal cost of intelligence, of accounting, of financial services, of legal work, if the marginal cost of that trends to zero or as close to zero as possible, that means that your capital goes further, right? You can raise a family on low income now because you don't need all of these things anymore. It brings the cost of everything around you down. Now, the reason that is a problem, this is a really important point. You have to understand why deflation is bad in the fiat game that we've created, this debt-ridden financial system. It's because it collapses the debt that they've built. Why? Let me explain. If we owe $40 trillion, if the dollar continues to weaken and be worth less, it's easier to pay back $40 trillion. Think about it this way, guys. Let's say we go through so much inflation and we go through so much dollar debasement that it costs $40 trillion to get into a movie in 5 years, 10 years, 20 years. Well, then it's really trivial to pay back $40 trillion that we owe because it's only one movie's worth of time, energy, effort, and labor, right? The dollar's gotten so weak that the debt denominated in dollars is so easy to pay off. Now, if humans are so productive and they're building things like AI, which delivers such a productivity shock that's so deflationary, that actually has the opposite effect. It has the opposite effect. It means that people being accountants and people being lawyers and people doing all this white collar work and the US government collecting tax receipts from that isn't going to come close to paying off the $40 trillion because we're all going to be vibe coding our apps, living off whatever. There's going to be people living off low income, but they're just into history. They're just into making music. They're just into whatever artist, they're just into whatever they want. But you don't need that much money. You don't need to produce that much work and get that much taxed and speculate that much in the stock market. And it has the opposite effect where it gets increasingly more difficult to pay down the debt. And that's when you see if unemployment gets to 10%, then the US tax receipts come way down, then the deficit relative to the tax receipts, and you start to see a death spiral. And so when I say a deflationary force is meeting an indebted system and they're colliding, meaning they one of them has to win. If we go into true deflation and AI renders everyone unemployed and is like the biggest productivity shock we've seen in modern history, then we're entering a debt spiral, a level of austerity that like is magnitudes greater than the Great Depression. What happens is a credit crisis. So when I say a credit crisis is looming, shit's hitting the fan. The last episode, I'm bringing up delinquencies. Now I'm talking about white collar joblessness. I'm talking about the level of unemployment in the youth. Credit crisis meaning how much of our economy is predicated on mortgages, on car notes, on credit cards. If retail can't afford their payments, they're rendered delinquent. And what happens? Bank stocks are going to crater. Bank stocks are going to crater because the market will realize they have all these outstanding loans and they're not going to get paid back. When bank stock craters, stock markets crater. Stock markets crater. The 401ks are in the shitter. 401ks are in the shitter. The U.S. government tax receipts are in the shitter. The tax receipts are in the shitter. Then the bond market gets volatile. The bond market gets volatile. The U.S. defaults. It's a giant game of charades. It's a giant Ponzi scheme that's predicated on more debt, more money printing. And so the whole solution to this game is they have to print an immense amount of money, like an ungodly amount. I'm talking about magnitudes bigger than COVID. And this isn't me. I'm not biasly wishing for this. I'm just doing the math. Like there is a certain amount of liquidity that's going to have to combat these deflationary forces and provide the liquidity necessary to persist onwards.
Mahler's core thesis begins with a concept many investors misunderstand: deflation. Technology, by its very nature, is deflationary. Every major innovation, from automobiles to the internet, increases productivity and reduces the marginal cost of goods and services. AI represents the most extreme version of this trend. When intelligence itself becomes cheaper, scalable, and increasingly automated, entire cost structures begin collapsing across industries. But here's where the tension emerges. Deflation is beneficial in a productivity sense, yet destabilizing in a debt-based monetary system. Modern economies are engineered around inflationary expansion. Debt becomes easier to service when the currency weakens. Growth assumptions remain intact when asset prices rise. Deflation reverses that dynamic. It increases the real burden of debt, compresses margins, and exposes fragility embedded within credit markets.
Another way to think about it is, theoretically, because humans are constantly producing technology that's more efficient, providing value and providing productivity gains, everything around you should be getting cheaper. And evidence of this is Bitcoin. When I got into Bitcoin, one house was like 100,000 Bitcoins. Now the average house is like 5 Bitcoin. Life has gotten immensely cheaper for me in Bitcoin terms because humans have been more productive. If your money is fixed in supply, you get all the productivity that humans are constantly innovating. I'm soaking up all the gains from AI, soaking up all the gains from the internet. I'm soaking up all the gains from whatever research MIT labs are doing, whatever. I'm soaking up all the gains because my money supply is fixed. If your money supply is causing you inflation, where things around you are getting more expensive, that means that central banks and governments are printing more money than humans are innovating. Just sit on that for a second. Because the default state is things get cheaper because we are producing more innovative, revolutionary tech. Just think about that for a second. So the fact that we have been living through inflation means they're printing so much money that even the most revolutionary technologies aren't bringing the cost down of goods and services. And so in order for them to maintain the debt system that they've built up and not have an utter and complete credit crisis, debt spiral, they have to print enough money to outlast this AI deflation. And you've got all sorts of problems like what's happening in Japan, which we're not even going to get into in this episode. So here, this asset's a little small. Let me blow this up. Hold on. There we go. So this is from the Global Liquidity Index. I just subscribed to this guy's. His name's Michael Howell. Really good stuff. I just subscribed to his stuff. I just paid for his research stuff. Really good. And so he has this metric. Instead of debt to GDP, he does debt to liquidity, which is arguably better. And he shows this chart, debt to liquidity, and when it's high, you get these crises, right? So you've got the Y2K crisis, the Lehman 2008 crisis, the Eurozone banking crisis. And when it's down, you get these bubbles. So you've got the US housing bubble, you've got the everything bubble, which is COVID. And you see debt to liquidity trending up. It's trending towards crisis mode, okay? And so this is plumbing data. So what's the debt to liquidity? Yes, there's a lot of money printing and there's some liquidity, like the Fed paused QT, it's restarted some kind of form of QE. But the question is it enough printing to prevent a credit crisis? And this is just looking at the debt to liquidity. This is not taking into account the deflationary force that is AI, okay? And so when I zoom back out, the cracks are already starting to show. So last week, Blue Owl came out and they halted withdrawals. So Blue Owl limits investor withdrawals, stirring private credit concerns. Blue Owl, their stock got crushed. Blue Owl Capital Inc. shares tumble after a decision to restrict withdrawals from one of its private credit funds raised fresh concern over the risks bubbling under the surface of the $1.8 trillion market. Again, so people want to say, isn't Bitcoin the new gold? Isn't Bitcoin the new gold? This market is bigger than Bitcoin. Bitcoin's still small. Give it a rest, okay? Shares of the alternative asset manager fell about 10% on Thursday to their lowest level in 2.5 years. Now, Blue Owl came out and gave a statement and said, whoa, 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 whoa. Like, we're solvent, we're fine. And then Bloomberg comes out with another article that says Blue Owl sold their loans to pensions and their own insurance asset manager. And so it's like, oh, who bailed out Blue Owl? And then you read the article and you realize they bailed themselves out by selling themselves these loans. How is this not 2008 all over again? I mean, you got to be shitting me. No wonder Bitcoin's been in the shitter. Bitcoin doesn't know any better than to be the most sensitive thing to fiat liquidity, the most sensitive thing to fiat credit. It's all it knows how to do. Just be honest. And so, I titled this slide, Euphoria Meets Reality. Since COVID, the performance of stocks and the sentiment of consumers has totally divorced. We're totally living in K-shaped. Look at this. This is a K. Everyone's depressed. Everyone's violent. Everyone's protesting. Everyone's revolutionizing. Meanwhile, our president is like, well, if you look at the stock market this way, no, president. Pam Bondi, the woman that grinds my gears, is like, hey, how about we arrest these people, these demons that were raping and killing our children? She's like, well, look at the Dow. You've got these idiots, these morons, telling me to check the price of the Dow. Meanwhile, our entire country is on antidepressants and Ozempic. Sickening.
Bitcoin is extraordinarily sensitive to liquidity, credit conditions, and systemic instability because it exists outside the traditional financial architecture. It does not respond to earnings. It does not rely on corporate cash flows. It reacts to monetary stress, to cracks forming within the system it was designed to hedge against. This helps explain why the broader crypto market has felt deeply disappointing for many investors this cycle. Despite technological breakthroughs, institutional adoption narratives, and repeated bullish catalysts, the euphoric blow-off top many expected never fully materialized. Yet this dynamic may already be shifting. This week's price action is beginning to reflect a subtle but important change in positioning and capital flows. US-listed crypto ETFs have registered broad-based inflows, marking one of the rare sessions where nearly every major product finished in positive territory. Spot Bitcoin ETFs alone attracted roughly $258 million in net inflows, with participation spread across multiple funds rather than concentrated in a single vehicle. That detail matters. It signals steady allocation behavior, not speculative chasing. The strength was not isolated to Bitcoin. Ether ETFs stabilized. XRP-linked products moved into the green. Solana funds joined the rebound. Across the market, flows suggest investors are gradually rotating back into digital assets after weeks of defensive positioning. Even XRP's technical structure reflects this shift, reclaiming key moving averages as short liquidations accelerated. These are not yet euphoric conditions, but they are early signs of rebuilding risk appetite. Viewed through Maller's framework, this stabilization aligns with a larger macro narrative. Markets are forward-looking mechanisms. They do not wait for policy announcements. They anticipate policy constraints. If the global financial system remains structurally dependent on liquidity expansion to maintain stability, then digital assets sit directly in the path of that adjustment process. Capital does not move because conditions are comfortable. It moves because incentives change. If markets are indeed beginning to price the next phase of monetary accommodation, even cautiously, the implications for Bitcoin and crypto shift meaningfully. The conversation moves away from speculative cycles and toward monetary regime dynamics. Not whether liquidity expands, but at what scale, under what pressures, and how capital responds. Because the most important transitions in markets rarely announce themselves with clarity. They emerge gradually, through flows, positioning shifts, and subtle changes in investor behavior, long before consensus narratives catch up. If you found this analysis valuable, hit like, subscribe for more structured investor-focused breakdowns. Thanks for watching, and see you in the next one.